Hi, I'm Brooke Thackeray with Horizons ETFs. Thank you very much for joining me today. Today I'd like to use the Horizons Seasonal Rotation ETF, ticker symbol HAC, its weekly commentary, as a basis for this market update. So let's jump right in and take a look at the market action last week in the markets. Here you can see that the S&P 500 was up 1.2%. The Canadian stock market bettered the U.S. stock market with a gain of 1.7%. Once again, this was largely the result of the Canadian banks outperforming the broad market. Last week, we did see the majority of the major Canadian banks releasing better than expected earnings, helping to support the Canadian stock market. In other news, last week, we did see the initial jobless claims came in. They fell to 406,000. Which is less than expected, which is good news. This helps to offset that really weak non-farm payroll number that we saw earlier in the month. Other news last week, we did see the Personal Consumption Expenditure Index came in at 3.1%, which is higher than expectations. Now, the Personal Consumption Expenditure Index is an alternative measurement compared to the CPI. In fact, it said that the Federal Reserve prefers to use the PCE as to help set policy rather than CPI. It focuses more on the PCE. And recently, we have seen investors become a little bit concerned as they've seen the majority of the numbers coming out with inflation being higher than expected. So it's a little bit of a concern from that perspective. We also did see last week Biden came out with a proposed budget of a deficit of $6 trillion for 2022, which would increase the national debt as well. It's really the opening bid for negotiations, and the stock market did not move very dramatically. Also last week in the markets, well, let's take a look at what HAC was up to as far as some of the major changes that were made in the portfolio. Last week, we did see that HAC did reduce its position or exit its position in the utility sector. Recently, we have seen the utility sector underperform the S&P 500. HAC only had a small position in the sector, but it did flip it down into the U.S. REIT sector, which has actually been outperforming the S&P 500 recently. Other changes, it did reduce its U.S. dollar position as well as it increased its short sell position in the U.S. material sector with an offset in the S&P 500 as well. If we take a look at the action in the overall markets with the different sectors in the market, it was an interesting week last week. Here we saw the S&P 500, this red bar here, at 1.2% gain. And let's take a look, first of all, at what sectors were the losers. And if we take a look, it was the consumer staple sector, the healthcare sector, the utility sector. And these sectors are all the defensive sectors. Now, the exception would be the U.S. REIT sector, which actually was positive and outperformed the S&P 500. But the core defensive sectors underperformed the S&P 500. Usually at this time of the year, they tend to outperform. But last week, we saw investors shift. And where did they go? They went into some of the growth sectors, particularly while we did see the technology sector actually outperform the S&P 500. The cyclical sectors also benefited as well. So we saw the industrial sector outperform the S&P 500. Now, the U.S. materials sector was positive, didn't quite get to the level of the S&P 500. The U.S. materials sector is largely made up of chemical stocks, approximately 70% in chemical stocks. And that sector, the subsector of the chemical stocks, was actually has been underperforming recently. But last week, what's not shown on this graph is we didn't see the metal sector and the metals and mining and the steel sector, all these subsectors outperformed the S&P 500. So what's happening in the markets right now? What happened last week? Well, it's actually quite positive, the action last week in the markets, to see both the growth sectors and also the cyclical sectors perform quite well in the markets. And this basically shows that investors still have a little bit of an appetite to risk. Now, we are at a month end here, so it's possible we could be seeing this bump here, and it could go into the month of June here as we come into the next month. And we could see a little bit of a rally coming up as at least at the beginning of June. Now, we still are under the all-time high for the S&P 500, which was set on May the 7th at 42.32. We're just below that level. But with the positive indications we saw last week in the market, we could see it edge up a little bit closer to that. But These would be still considered to be short-term moves in the market. We're still in the 6-month unfavorable period for the stock market. We're close to all-time highs. This is still a time for caution, as we could see this rally actually start to peter out shortly, particularly based upon seasonal trends at this time of the year. Thank you very much for joining me this week. Thank you.